The short line is a candlestick pattern that can provide valuable insights into potential market reversals. This pattern consists of a single candlestick with a small body, indicating a lack of significant price movement. It is characterized by a short body that opens and closes near the same level, with little to no upper or lower shadows. When observing the short line pattern, it suggests indecision and a potential pause in the prevailing trend. It can be a signal for traders to exercise caution and consider potential changes in market sentiment. The shooting star is a bearish reversal pattern that can provide valuable insights into potential market reversals. This pattern consists of a single candlestick with a small body located at the lower end of the overall range and a long upper shadow. This formation signifies a failed attempt by buyers to maintain control as selling pressure overwhelms the market. To incorporate the shooting star into your trading strategy, wait for confirmation by observing the following criteria: a preceding uptrend, a gap-up opening, and a bearish candle that closes below the midpoint of the previous candle. When these conditions are met, consider entering a short position, placing your stop loss above the high of the shooting star candle, and targeting potential support level. This pattern consists of two candles that meet or touch each other, signaling a potential trend reversal. The meeting lines pattern can appear in both bullish and bearish scenarios. In a bullish meeting lines pattern, the first candle is a bearish candle, followed by a bullish candle that opens at or near the same level as the previous day's close. The two candles meet, creating a visual representation of a potential shift in market sentiment. This pattern suggests a struggle between bulls and bears, with the bullish candle indicating a potential reversal of the previous downtrend. To identify the side-by-side gap-up pattern, there are a few key criteria to look out for. First and foremost, we need to have an established uptrend in progress. This means that we want to see a series of higher highs and higher lows on the price chart. Next, we will be on the lookout for a white or green candle, which signifies the continuation of the upward price trend. This candle should be followed by two more white or green candles, forming a side-by-side alignment above the body of the first candle. It's important to note that there should be a gap up between the first and second candle. In terms of the second and third candles, their bodies should be of a similar size, indicating consistent buying pressure. Furthermore, both candles should open and close at the same price, emphasizing the balance between buyers and sellers. The stick sandwich pattern is a three-candle formation that can be seen during both uptrends and downtrends. This pattern consists of a bullish candle, followed by a bearish candle that gaps below the previous candle's low, and finally, another bullish candle that closes above the previous bearish candle's close. To spot the stick sandwich pattern, keep an eye out for the following characteristics. First, there should be an established trend in place. Second, the first candle should be bullish, indicating bullish momentum. Third, the second candle should be bearish and open lower than the previous candle's low, creating a gap. Finally, the third candle should be bullish and close above the previous bearish candle's close. The stick sandwich pattern suggests a temporary pause in the prevailing trend, indicating potential market indecision. It often signifies a battle between buyers and sellers, where buyers regain control after a brief bearish pullback.